Hi there, and welcome to Money Managers, a User's Guide. I'm Nathan Peters. Today, I have the pleasure of reviewing a private hedge fund manager, Theron DeRis at Eschler Asset. Theron has been watching the videos and reached out to me with an interesting, long-term audited track record with a unique fee structure, no management fee, and a performance fee that only accrues after a 6% compounding hurdle rate. So he has to basically exceed the historical equity risk premium every year before he makes a dime from his investors. Sounds like a pretty good setup to me in terms of value for money. Full disclosure, I have personally known Theron for many years, but I'll be keeping the review strictly factual from the returns he kindly furnished me. If you wish to know more about his investment philosophy and process, I'll leave a link in the description below. So in terms of what we can see from the track record, which began in October 2012, we see that he indeed exceeds the hurdle rate, compounding at about 8.5% per year on average. This is very satisfactory at a headline level and approximates the returns from a standard 60-40 portfolio of equities and bonds. But as we dig deeper into the analysis in Venn, we see that the fund is considerably riskier as defined by the standard deviation of those returns. And the drawdowns have been steeper, losing a maximum of about 36% versus 13% for the 60-40 portfolio. What is the cause of this excess volatility? Well, in sum, I would say Eschler is a long biased, deeply contrarian stock picker, as we see here the long beta to equities, long commodity beta, short low risk, and short momentum beta all contribute meaningfully to overall risk. But we can see that unlike the benchmark, fully half the risk is generated by security selection, or alpha. And we look a little further, we see that Eschler makes about 8% per annum from this. So really, the rare, valuable stuff, the alpha, accounts for 100% of the fund's overall return, and the rest of the volatility is just noise, potentially painful noise, I'll grant you, which is, however, zeroed out over longer periods. In fact, if we just focus on the residual line, we see a superior Sharpe ratio for this activity of 0.6 versus the overall fund's Sharpe ratio at 0.4. And if we draw a cumulative alpha graph for the fund, we see the accrued value of the strategy clearly versus the market portfolio. You don't pay much for the market portfolio, but you don't get anything different either. Eschler has created a unique value for its investors, and it was only paid because it did so, not because it was there in a bull market. And speaking of bull markets, this brings me to the crucial point of this week's episode. With negative expected real returns across all asset classes now over the coming years, I would strenuously argue that the very rearview mirror that we feature on this channel is as useless as it has been since the datasets I look at began in 1958. We currently have the lowest ever blended real expected returns across equities, bonds, cash, and credit. We can actually incorporate that outlook in Venn, and we can see that on a forward-looking basis, we have no expected return from the all-weather portfolio, which was popularized by Bridgewater and contains a risk-weighted allocation across beta assets. Everyone's expectations from beta assets will need a drastic downward reassessment, and it may be the case that the only return that can be generated will come from exactly the type of stock picking skills which we've just identified with Eschler, which forms the foundation for the fully active hedge fund universe as a whole. So get out there, listen closely to how money managers make money, vet what they think they're good at, investigate whether their history supports their assertions, and place your bets with people you think are most able to add value over and above market betas. I promise to do my part to help in the process. It may be our only hope to retain purchasing power in the coming years. Thanks for making it this far with me on Money Managers, a User's Guide. If you enjoyed this content, please like, comment, subscribe, and hit the bell for notifications. And remember, use your money managers. Don't let them use you. Thanks.